So recording is on now. Good morning, good afternoon, guys. And we will soon be saying good night to Sundar by the time we finish the session. Thank you for joining. Appreciate it. Appreciate taking time out of your busy schedules. So we'll crack on. So before I kick off, some disclaimers. This is a brainstorming, knowledge sharing session. It's not about me saying something and you taking it way too seriously. So it's all about what we all collectively know and sharing with each other. Some of you may find this to be a little intimidating, especially when we go through a model. Some might find it to be what's a big deal, and for some it may not be relevant. So bear with us, go with the flow. So I caught up with few of you, with Raj especially, with Tamal, and then briefly with Arun, and I also had a chat with few of my friends here. So the whole thing started when I started wondering if I have enough to support me in the next 15 to 20 years. So the first question in my mind was, is everything okay? Have I got enough? Can I manage? Can I sustain? And when do at what age can I retire? So I have a, desired age when I want to retire. Am I in a position to retire at that age? So those were the kind of questions that were popping in my mind. And then it branched out to other questions like, what if something happens to me? Is my family going to be financially crippled, or are they, can they manage? Loss of life is always, cannot be compensated, but you don't want them to be financially crippled as well, because that's the worst thing that can happen. So are we, am I in that kind of a position? Will the family be okay? This was another question. So there were such questions, and I couldn't sort of find answers quickly. In my mind, everything was okay, but I couldn't, really comprehend if, that was really the position in which I was in. So I started putting down everything. There are many, many tools available to sort of give you a view of what it looks like. I'm not a tool person. Tool is where I will go, towards the end. I wanted to write in a way I could understand. I wanted to construct it myself. So I started putting everything down in an Excel sheet, which I will show in a bit. So it's not entirely my financials. It's modeled around my financials. And the idea is to sort of have a holistic view, put everything together in one place to see if collectively, if holistically it makes sense. So that's how it started. And I just want to get some initial views from Raj and Arun on what they felt when we had the conversation, what were their sort of impressions. So if you want to reflect upon a conversation and tell me tell the group what you felt. Raj, to start with.
Yeah. So what I felt is like that's what, right? So since we're in middle of our 40s, right, or approaching our 50s, right? So I felt like this is the high time to take a look at what we have. And again, since we all are professionals and come from, like, I would put us in upper middle scale, right, upper middle class section, right? So we have various ways of our own investment, right? And also coming from our background, we have like a different way of looking at things, right? But there is a common thread, right? Like we have some sentiments towards gold, some sentiment towards real estate, and also once we are exposed to equities and options, right? So, we have been discussing this for almost 6-7 months, but again, most of this is like either we had a plan. I'm assuming like most of us had a plan, or some we didn't even have a plan, also, right? But at the end of but the goal is to have to kind of everything is working towards the retirement, because our generation is going to be different, right? It's not like our parents' generation where we'll be entirely dependent, or will be more dependent on our next generation. So it's more like this. Murugan, when he shared, right, as he said, it's quite a little bit of overwhelming sometimes. But when you just slice it and take it one piece at a time, right? You will definitely fit into each of everything, like traditional way of investment, or also equities, and also investing in markets. So it's just like more like putting everything together. And his point is, at this point of our life, it's better to take a look at it, what we all have, and do some minor adjustment. So in our local group also, like our same age group, we started discussing it, and we found a lot of people who are contributing to their pension or to 401k, like in US, or any other retirement strategies, right? They haven't even logged in for long. So they just picked a few funds and they've been sitting it for long. And they already last like 5 or 6 years of a boom market, right? And then now if they don't understand what they're interested, what they have invested on, and what's going on, they have to just do the minor adjustment. Again, we are talking about any aggressive strategy or any what do you say, conservative strategy. It's more like understand what all we have invested, and take a good look at it, and just help out each other, because as Murugan said, right, so we all have our own knowledge and all this. This is more like bringing everything together on the table. So I think that's what I want to add. And
Thanks,
again,
Raj.
that's what,
Appreciate it.
yeah, that's what. So Murugan will talk from his country perspective. I know India has a totally different thing, so that's why we wanted Tamil to come and join, and then I can contribute a little bit from the US side. But again, everyone is already knowledgeable of most of the stuff, but it's more like taking a holistic view. Even the cash flow analysis, what Murugan will start with, that's also very important thing. That's what I think. So yeah, thanks Murugan for initiating it.
Thanks, Raj. Appreciate your feedback. So, Arun, any views from you?
Yeah, I mean, just to add, when we did the stock market sessions with Vijay, I had also discussions with him separately, and that helped us still about setting ambitions on our savings and having it in the right places. But with the discussions with you, Muruganand, I think 3 areas triggered my thinking. One is for people like us with a little bit of an hybrid living model, I call it. We were discussing the other day that, okay, the folks in India are very clear, hey, this is where we are and this is where we will be for long term. So we know everything around our planning should be around what we need to do in India. Folks in US also, a lot of you are already clear where you want to be. But we felt that there is an hybrid set of people like us who have been, say, 7-8 years here, but always had this thinking in mind that we will still have 1 feet in India. So we had kind of distributed our savings, and every decision we wanted to take in life, we always kept in mind, will I retire here or will I retire there? Will I settle here? Will I settle there? Should I save here? Should I save there? Property, where should I buy? So that kind of, a kind of an hybrid set of people, some of us are in between, keeping maybe Sundar is a little bit like that as well. And so that one reflection, I think some point in time we need to streamline our thinking and take a decision which becomes my core center of gravity place and which one is more a support place. Until now, I have been maintaining both as kind of my core. Oh, yeah, okay, I will buy a property here, I will buy a property there as well. I will open a mutual fund here, I do that in India as well, because just to, you don't know when that changes, kind of. The second reflection was the structured target of retirement. Somehow when you guys reminded repeatedly that, hey, now we are 45, now we are 45, it kind of started striking. Otherwise, honestly, I did not think about setting a target of retirement and building a corpus towards it. We are busy in developing a career, and we always look at, okay, we are busy, we work, we earn, and this, the assumption is it will always be like that. You don't want to think about slowing down, retiring, and all that stuff. But when this discussion, mail and the phone calls we had started, it did strike. Of course, you always have it behind your mind, but you don't put it in a structured way to bridge there and even understand if there is a gap, or not necessarily to extend, but it could be that, hey, fine, I want to enjoy life now. At 50, I would just say, it's okay. I mean, I take a break and maybe I can afford to retire. Even to decide this way or that way, I think a structured approach would help. And the third part, which we had a detailed discussion, is on this insurance piece. I think, at least from my side, this is something which you don't take too seriously, and and really build a plan around it. okay, you always have been convinced by somebody in India to take insurance, and most of us ended with LIC and those kind of stuff. I ended up a lot in this ULIP without understanding. I had a session separately with Vijay, and now it takes a while to get out of it as well. Vijay, I'm still struggling to get out of it, just for information. 1 month, I still not got my money out, even though there is no lock-in and all that. So those part on the insurance side, where it should be and how much it should be, and what is the thinking around it, these three areas are my reflections where I'm trying to become more structured in that sense, if it helps.
Perfect. Yeah. Thanks, Arun. Brilliant feedback. So, anybody else want to reflect or comment? Have any views, perspectives to share before we jump on?
Yeah, one thing I would like to add to is to have a passive income kind of thing, right? So if we decide to retire, like now, to get some passive income. Right now, what we do is active income. Right? So apart from what Vijay shared the other day, with all the, is there any other additional passive income we can look upon? No.
Yeah.
Some guidance around that.
Good point. Yeah, we'll discuss that. In the presentation. So yeah, good point. Anybody else?
One more thing about medical insurance, right? In India, if there are folks who have taken, or if there's good options, right? Right now, I think we are all covered through our company's group insurance policies, right? So I haven't been putting much focus on that. So if that,
so let me quickly comment on that. This is an realization I had several years back. When I was still working in India. If you're dependent on your company's health insurance and medical insurance, then that is a big mistake. You got to have your own for two reasons. One, may or may not cover everything. And two, if you're out of the company, it goes with the company. Yes, you will be still working. Yes, you will probably be, going from one company to another company. So you're always going to be covered. But there could be scenarios, there could be situations when you're between jobs, and later when you retire, you will retire with no medical insurance. And at that time, when you try and take medical insurance, it will cost a bomb. It will be just unaffordable, and quite likely you won't get one, because the older you are, the chances of you getting a medical insurance, at that age, the kind of health issues we're likely to have is just remote. So act on it right away, get your own medical insurance, see if you can increase the sum assured as time goes by, and get something that is good enough, that is fit for purpose. So that is definitely something to be picked up. Yeah.
Yeah, sure, Mohan. No, I knew all that. What I was asking is if people have done some analysis on good options in India who are staying in India, right? So.
Sure.
Okay.
No, I have a question regarding that. Is the premium fixed for health insurance too? Like how you can take in term life insurance in India? Like if you take when you're 30, is it the same premium even when you're 50?
No,
I have with Apollo Munich, and it's something I renew every 2 years, and it keeps increasing.
So then why do you recommend people take it now? If it is going to increase, why not? I mean, I know
it'll be disproportionately increasing if you take it later, Sangeeta. So if you go with them now, they will continue with you. I mean, they will allow you to continue for as long as you want. It'll increase a bit every time you renew it, but you will have continuity. And if you stay with them, if you do no claims, then your sum assured are the disclaimers or the refusals will come down and all that. So you have benefits to stay with the same provider for long. But if you do it later on, it'll come at a much higher cost. And like I said, you may not even get.
So you mean to say they don't do any medical test?
Yes. I mean, if you had started, I started my medical insurance in my 30s. So at that time, there was no need of any medical tests. They might have probably done some basic tests for me. I don't remember going through anything. But like I said, so you have to have when you sign up, you'll have the first 2 years, I guess, when they won't cover for any pre-existing illness. Once you're over that phase, you're with them. throughout. You're with them as long as you want to be with them, and they will allow you to continue with them, and you will have benefits of having no claim bonus and all that. But the moment you get out, going back is very quite difficult. And once you're in your late 40s and 50s, getting a new health insurance is just next to impossible. One, you'd have to go through a battery of tests.
If you have the background issues, health issues, then the premium gets increased. But if you take it earlier, like as one said, 30s, then even if you get health issues, that's not considered. That will be included as part of your cover. They won't cancel it or they won't increase it. As soon as they know you are going to apply the insurance and your health conditions, or even the small things also, pre-diabetic and other things, there are a few other small things also, they increase the premium, double the cost. For example, UK, we pay 20-30 pounds monthly. If you have small health issues, it increase up to 80-60 or 80-90 pounds, easily goes. And also, life insurance is better to take the longer term. Don't take for loan cover or any other thing. Take it for up to 70, 80. I think mine all is 85. So after 70 is the more risk. So until
I have a slightly different view to health insurance. I share the same view to have it for a longer duration. I'm now convinced that I should rather take it for as long as I have for retirement, because if in 15 years, something happens to me, after 15 years, I don't think my family would be financially crippled as much as they would be, if something would happen to me now. So, if I build a retirement pot for the family, and if I'm no more, the family can still have the retirement pot. But if something happens to me now in the accumulation phase, when I'm still in the process of building wealth for a nice retirement, then they're going to be financially crippled. So so far I've been thinking about having a life insurance for as long as possible, for as much as I can afford. I've had a change of thought. I still haven't refined on it. I still haven't made a final decision on it. I'm now thinking of having what is called reducing policy value insurance, where it'll start off with a big sort of sum assured, and then it'll taper down as we go along. That will be in line with the wealth that I build. So that's how it's going to be designed. So as I move along, the value will come down. In 15, 20 years, when I decide to retire, I will have no insurance, and I don't need any insurance, because then I will have enough to support the family.
Insurance is a separate topic itself, right? So I think it will be a big one. I think
So first we'll have a
separate. We'll have a separate.
So we'll push insurance to the later part of today, or maybe on the next session next week. But just to sort of touch upon some basics around insurance.
But Vinay, you are a part of that investment group, right? So just ask a question there, so at least people can chime in, or even in any group you want, so that people. At least they can start discussion.
Let's move on. I think.
Let's kick off and crack on, guys. Okay, so this is I'm going to share my screen. Let me know if you can see it. Yeah.
Yes.
Can everybody see my screen?
Yeah.
Yes.
Okay. All right, so I circulated these questions before the presentation. You all would have had a chance to discuss. So these are the kind of questions I had in my mind. Sorry guys, if you're not speaking, can you go on mute, please? There's a lot of background noise from somebody. So these are the kind of leading questions that popped in my mind, for which I was trying to find answers, and I was trying to make sense of what it meant holistically. So this is what we will be trying to answer in this session today, and potentially the next session. So quickly to go through the questions. At what age do you want to retire? Do you know how much you need annually post-retirement, factoring in inflation, the effect of inflation? Have you forecasted your milestone expenses? How do you intend to meet those milestone expenses? How do you intend to reinvest maturing investments? Some of us have got investments in some debt kind of instruments in the past, when we were not this savvy on markets and that sort of investment strategies. A lot of us would have started with investments in LIC and fixed deposits and whatnot on some long-term commitments. When they mature, how do you intend to reinvest them? Do you rebalance your portfolio regularly? Have you had a look at your properties? Because the bubble around property has definitely burst. It's no more booming. Some of the properties are hardly appreciating. My own property that I have in Bangalore, I got to know what the selling price today is, and it was heartbreaking because there's hardly any appreciation. Is your risk appetite aligned to your requirements? Is your risk appetite actually helping you or not helping you? Is it turning against you? Is it stopping your sort of retirement planning? Are you taking full advantage of pre-tax and tax-free equity-oriented investments? Especially if you're not well versed with direct equity, like the way Vijay, Sundar, and a lot of people are. If that's not your cup of tea, do you have other investments where you get some tax exemption, so that sort of delivers more returns? Have you thought of a job loss for a month, few months, what it does to your sort of wealth accumulation? How much does it set you back by? Can the family still meet all the expenses? This is a conversation we just had, in terms of insurance, in terms of financial cover. Are they going to be well off if something were to happen to, the main breadwinner? Have you set up a will? It's extremely important in this part of the world where will decides everything that happens. If the breadwinner of the family, is no more. And will can also, support inheritance, working around inheritance tax and that sort of thing. In the absence of a will, a lot of confusion will arise. Is the family up to speed with your financial strategy? Have you discussed with the family? Are they up to speed? Do they know what to do in your absence? Are they playing a part? So those are the kind of leading questions. So a sneak peek of what's going to be discussed. I will introduce to you what I have done, what my starting point was, what sort of reverse engineering I did to arrive at, what I need, what I could, what I could get, and what the gap is. We'll talk about retirement pod and various options post-retirement. We'll talk about cash flow management. We'll talk about milestone income and expenses, why liquidity matters, why effective cash flow management matters when it comes to meeting the milestone expenses. Quite often we have enough, but we still take out an unsecured personal loan or a top-up loan or whatever, which again sets you back. It will sort of slow down your progress and wealth accumulation. We will talk about investment avenues right after this slide. So I'm going to sort of digress and take a segue into talking about various investment avenues before we go into the financial model. We'll talk about the three levers we have in terms of accumulating wealth and having enough for retirement and until retirement. And if time permits, we'll touch upon inheritance, get view from everyone on what inheritance means to each one of you. We'll talk about the what if scenarios, like something were to happen to us, joblessness and whatnot, and a family strategy. I doubt if we will have time for that today, but if not, we will do it on the next session. So in terms of investment avenues, so I'm using these acronyms. Don't get put off by these acronyms. They are sort of self-explanatory once you understand what I mean by it. So these, there are various investment types. And I'm starting with what is EET. In India, you also have what is known as EEE. That is, whatever you invest is exempted from tax. Whatever growth you achieve is exempted from tax, and whatever returns you get is also exempted from tax. And that happens to be the company PF. There is nothing like EE anywhere else in the world. I think India is unique that way. You only have that in India, and that is up to 1.5 lakhs that you get exempted under 80CCC for PF investments, and that is completely tax-free throughout the life cycle. In this part of the world, EET is pretty common. So this is where you invest your pre-tax money into most often a pension plan, And especially if you're working, and if you don't work, you can still do pensions as a self-employed, and government will incentivize for investing money into pension pot. And that is exempted at the time of investment, exempted on growth while it's growing, but it is taxed later on when you withdraw. And the idea here is you avoid high tax, because that's what you will be paying now on income. You'll be, most of us will be on high tax category, high income tax category. But later when you retire, you pay much less tax because your income won't be as much. And as a senior citizen, as a retiree, you'll have a lot of other benefits as well. And you can also draw it down in such a manner. You can withdraw in such a manner that you stay within that low tax bracket and get less tax as possible. It also allows you, there's this sort of investment is also market linked. So you can have this investment going into funds, and very often you can also have equity exposure. So it allows a decent level of growth as well. So in the US, it is called IRA. So Raj will talk about that in a bit. In UK, we call it workplace pensions, and for self-employed like Anand is, there is SIP, self-invested pension plans. There is an annual limit of about 40K. I think in the US it's 19K. In the UK it's about 40K.
Murugananda, just small correction. That IRA you can put in front like 401K. That's actually the actual employer, the 401K importer. Yeah.
Okay. Got you. Yeah. Got you. Okay. So in the UK, one can invest up to 40,000 pounds per annum, and in India, correct me if I'm wrong, guys, you've got a 50K exemption on NPS. And the good thing about these sort of plans is there is also a contribution from the employer. So you get immediate returns in the form of the match done by the employer. And then the whole money is, you have the option of investing in markets and getting high yields. Like I said, in terms of withdrawal, when you withdraw it, you can find ways to minimize, avoid tax. So in terms of pros, tax exemption upfront, net tax deduction, it also helps you in reducing your tax of the year because it is pre-tax, that is not treated as income. So that, to that extent, your income tax burden will come down during the year. There are double returns. Like I said, there is an employer match, and the whole thing will fetch return on investment. There is a long-term lock-in, which I think is a great thing. You have a commitment. Once in, you can't touch it. It's no longer retirement is many years away. I'm not too bothered about retirement because it's not something that is going to happen anytime soon for me. Types. We only have 15 at best 20 years before we want to drop everything down and sort of take it easy. So it's no more a long-term commitment. Even in equity, we say long-term, give it 10 to 15 years to mature and yield a good level of investments. That's the amount of time we have even on building a pension fund. And it is market linked. In terms of cons, disadvantages, you have to pay tax on withdrawal. You cannot access it during emergency. And if you are taking the fund route, then there will be some fund management charges and admin charges and whatnot. In developed countries, the fund management charges are a killer. Some of them charge exorbitant fund management charges. There's always some low-cost fund management company and whatnot, but that is a factor. Okay. Comments, views, perspectives before we move on to the next investment category. Anybody?
I think there is no tax for.
Go ahead.
Just one point here, actually, in UK, I think Muruganand, I think there is no tax for up to 25%. I think, correct? When we withdraw.
Say it again.
You mentioned in the cons tax on withdrawal. I think up to 25% there is no tax, correct?
Yeah. There is still a tax. Like I said, you can work around withdrawal tax. You can do your smart way of withdrawing in such a manner that you pay much less tax. So the way pension works anywhere in the world is part of the pension pot can be taken out without paying any tax. In the UK, it's about 25%. I think in India, it's about 30 or 40%. Correct me if I'm wrong, guys. And the rest of it, you'll have to either take an annuity, like a monthly pension. So you have to invest the rest in a pension plan, annuity plan. Or in the UK, I don't know if that's the case in the US, you also have a drawdown option where whatever you draw down every year for sort of managing the expenses, part of it will be subjected to tax. So yeah, that's the way it works.
Yeah, I think in US there is a penalty if you do an early withdrawal. I think it's 10%. I don't think there's a limit for that, but yeah, you don't want to do it.
If you do a late withdrawal, you still will be paying income tax proportional to income at that time. Yeah. So
that penalty is over the top of I think your tax you have to repay, right? So that's one. And the access during emergencies, I think US let you to tap into that funds for your first home buying. So that's one thing I saw in US. So they let you borrow from your 401k, and again you have to repay that as a loan. So for the first time home buyer.
Fantastic. Any comments on IRA 401k? You had some findings. If you want to wait till the last slide of this investment revenues, you had a consolidated slide of everything that is possible in the US. Maybe I'll pass it on to you at the end of these 3-4 slides.
Yes.
Cool.
Sure.
Okay. Comments from India on this particular category? Anybody from India who's investing on NPS, who finds NPS to be a good use of what you want to build for your pensions? Does anybody do NPS in addition to PF?
Yes.
And do you get a employer match on both PF and NPS?
PF will get an employer match, but NPS I pay. I am doing on my own.
And do you invest that investment that goes into NPS completely into markets? You do direct equity through funds?
It's up to us. I mean, we can decide on the plan. Basically, we have 3 options. We can invest in 3 types of plan. It depends on our appetite. So there is a government bonds and moderate risk and full risk equities. You can decide 50, 30, 20. 50%.
Yeah, do you agree with the statement that we've been making here, that this has to be completely exhausted? Make the best out of this. Go full on, because this is a no-brainer, right? This is one for your own.
Again, as in one of our discussions, Subbu mentioned, right? If you are going to invest in equities, what is the point in investing in NPS? So there are differing views. I mean, earlier it started as a cover for your tax, but right now I made it as an investment.
But isn't that isn't it valid that you get tax break upfront? You get tax exemption upfront, and that is quite significant. In the UK, like I said, we have 40k. 40k is quite a big number. Really hard to invest 40k every year in pensions. But if one way to do it, that 40k is taken off from your income, and the rest is tax. The rest of the income is tax, and that tax burden will come down significantly. So it's sort of it's got 2 or 3 significant advantages. You get a employer match. You commit yourself into a long-term sort of wealth building. And third, you also have this tax burden coming down on a yearly basis. So there are some inherent advantages. Isn't that how you see it on NPS?
Yeah, there are advantages, but not to that extent. At the max, we will get 17,000. The save only we can make per year. That's it.
Right.
No, okay. That's what the way at looking at this is right. There are 2 things, right? One is the taxing. Definitely, you have to do your own calculation. Another one is the employer match, right? Because that's a part of a package in at least US and UK or Western countries, right? It comes it's a part of your salary, right? So what they do is sometimes they match like 50% of 19k whatever Murugananda showed, right? So which means you're leaving 10k on the table, right? So from that perspective, his approach is kind of first try to exhaust or what options here. But again, if you're really there's a 2 thoughts, right? Like Sundaram, like I can save 19,000 I don't want to put it in a long-term locking period, but I'm very well versed with the equity market. I will just do a post-tax, like I have to pay tax right now, and then go into the equity and it'll make money. But again, if you see, you're paying tax on that, and again, you're going to pay tax on capital gains, right? So that's also there. But this is the avenue where a company provides you to start with as a saving. But again, the common line of all this employer thing is, it comes from the perception, it comes from the idea from the government or from anyone is, a lot of people are not saving for their retirement. So let's start with a vehicle. So this is the first vehicle any employer provides to their employees. Hey, this is what it is. In order to force them to think in that direction, that's where the matching comes in. And then the government steps in saying that tax exemption and all those. So that's a pure thing. Yeah, but yeah, some people look at it differently. But I think majority of, at least in US, people started or they already started in the 401k. If it is, yeah. So, yep, that's my view.
Okay, so moving on, guys. So the next category that we're talking about is TEE, which is your, sorry, was it a question?
No, the previous slide for India, there are two more avenues you can park for your retirement, right? So one is obviously the EPF does your provident fund, right? So and there is one more thing called a PPF, right? So where you can also go ahead and open a PPF account, and like even any banks, you can open it, and you can park there up to 1.5 lakhs per annum. Again, that has tax benefits, right? I mean, like post-retirement tax benefits.
Isn't PPF TEE? You invest your tax income, don't you? You don't get any. Yeah. So that is what we're covering on this slide. So it's not quite EEP.
Okay. So there's one more. You also have a voluntary provident fund, right? So that one, out of your salary, you tell your employee as part of your EPF, add some percentage of your income, and that also go on. It's going to add on top of your EPF, right? So just I thought I will add here just in case you're not aware.
No, it's a brilliant comment. I'm covering that here, but isn't VPF also post tax? You're not investing, so that's also TEE, right? That is also in this category, not quite EET. So when we talk about EET, it is something that is invested before you get taxed on your income. And I don't think that quite exists in India, except in NPS, where you get your tax given back. You know, you can get an exemption for the 50,000. You know, here in the US and in the UK, it is not even subject to that part of investment. Is not even subject to income tax.
Got it. I'm not familiar with TE, but it looks like it's similar to EPF. Okay, got it.
Yeah.
Okay,
so, what we
actually, the VP, Murugan, to add to Murugan, right? So VPF is post-tax.
Yeah. VPF and PPF both are post-tax according to me. So where you invest your tax income, but everything else from that point on is tax-free. So in the UK, we call, we have something called an ISA account, where whatever you invest in ISA up to £20,000 per annum, and that can be in simple savings or even in stocks and shares. That's all, and also in funds, mutual funds. Everything is exempted from tax. Whatever returns you get, whatever withdrawals you do, will all be exempted from tax up to 20K per year. In the US, I think it's called Roth. Is that right, Raj? And you've also got some HSA, FSA kind of things. Where you invest your post-tax money, but it's tax-free from that point on. In India, to the best of my knowledge, you've got the insurances, the endowment kind of insurances from LIC, ULIPs, anything that is linked to insurance is tax-free when you get the maturity benefits. You also have PPF and VPF, where you can invest either through your salary. It can be a salary sacrifice. You can ask your employer to deduct something that gets similar returns as your PF, and PPF is predominantly for people who do not have a PF option, but even those who have got PF can invest in PPF, and you get some decent returns. The advantages with that is it's growth and withdrawal are tax free. You get instant access. It's fully full liquidity. you can access it anytime. So on an emergency, that is the one you will go to because it's instantly accessible. It can be market linked. I know in India it's only the ULIPs that are market linked. Otherwise it's not market linked. But the returns on EPF is pretty good, especially for those who do not have the appetite for investing in markets, that do not have the knowledge to invest in direct equity and can be put off by it, who want inflation beating returns. VPF and PPF could be very, very good alternatives. In ULIP, you got to know your way. ULIPs are, I never found ULIPs to be good enough. I burnt my fingers on ULIPs. Arun shared just now that he has similar experience as well. I think ULIP is not everyone's cup of tea. You got to really know your way on ULIPs. So that's probably the market linked exposure you can have in India, but in the US and in the UK and developed markets, the TE investments can also be market linked. And Arun recently discovered something similar in Sweden. It's called the ISK account, where you can have market linked, equity exposed investments and have returns almost tax free or pay very, very less tax. In terms of return on investment, it is going to be proportional to your risk appetite. You got to have some knowledge of share market and how to invest. It is quite a good instrument, quite a good vehicle for self-employed people. In terms of disadvantages, you are investing a post-tax money. Instant liquidity can be helpful as well as can at times be unhelpful because you'll be tempted to access this money whenever you need it. So there is no commitment, there is no lock-in. There could be some fund management charges and brokerage that you have to pay. You have to be financially savvy to get the maximum possible returns on this. The next category is the most popular category in our group, is especially which is TET. So you invest your after-tax money in markets, market kind of instruments, and you pay capital gains happily on your returns. And you still believe in what you can do in the markets, invest in the right avenues and get the maximum returns. So market is the most popular avenue, but you've also got properties and gold where you have similar sort of structure. You invest your after-tax money into it, and on the gains that you get out of it, you pay capital gains tax. In case of property, you have an indexation benefit that is again available only in India, not in this part of the world. And on equity, there was never a tax, but now you have a tax, and I only expect that to go up. It's currently 10%. It can go up significantly over time, especially when the economy is on recovery path. Gold is something that we find different ways to buy, but strictly speaking, gold also has a capital gains aspect, so that is also a TD kind of investment. Advantages: you don't have any cap on investments. You can invest as much as you want. You have full freedom on what you want to invest in, what you believe in, what is your cup of tea, your core competence in terms of getting the maximum possible return on investment. Play by your risk appetite. It gives you instant access. Especially if you invest in equity, you have full access, full liquidity. Not so much in property or to the extent even in gold, but liquidity is something that you can find a way you can find a way and you can decide how much liquidity you want. In terms of disadvantages, capital gains tax could be a dampener, especially on equity where we never had capital gains in India. Instant liquidity, like I said before, can be tempting. Fund management charges can take away some of your returns, and you got to be a savvy investor to make the maximum out of what you invest. I know this is an area where a lot of us are very active. We have a lot of discussion, but I also appreciate the fact that not everyone, everyone is that much into markets, and they look for other ways to have their investments diversified. So we've discussed 3 categories now, so that there are multiple ways to diversify, multiple ways to sort of have your eggs in different baskets instead of having them all in one. Finally, the last category is not so popular. It's mostly for protection, mostly for having some money in hand, having some instant access, quick access sort of money. It's where some of us will park any lump sum. Some of us who are not too sort of comfortable with parking big money, huge amount of money in markets, for that matter, even in property or in gold in one go, we would want to start off with some very conservative instruments like fixed deposits and debt instruments and that sort of stuff, where very well your capital will not erode, your returns may not beat inflation. So as a matter of fact, money is actually declining, but your capital isn't eroding. Right, so that's TTE for you, where you invest your after-tax money, you pay tax on growth, so you pay tax on the annual returns, annual interest gains that you get, but when you withdraw, you don't pay any tax. Should I pass on to you, Raj, to give a quick overview of what you've got, from a US perspective? Are there any questions before we let Raj cover a bit of the US?
I think when you talk about the US audience, right, it's only me and Sangeeta here. It might get bored or I don't know, it might make relevance for the larger audience. But what
Raj, I'm also there. Okay. So.
Okay. So no, let's. My thought is Danda Serida. It's like you wanna pick any of this and just kind of deep dive in a generic perspective, or what does the group feel like? Let's get their thoughts. It's all acronyms, but if you, as he said,
hey Raj, since the session is getting recorded, it's better we talk on all the zones, right? So that way we can share the details and people can listen to.
Okay.
Yeah, keep it quick, Raj.
Okay.
If you can just give a quick overview, that'll be helpful. If anybody from India wants to sort of reflect upon what we covered and pick instruments that they find are pretty good in each of those categories, that'll be greatly appreciated.
Okay. Good. One second, how to share it.
And Arun, feel free to comment as well. Sundar, feel free to comment from Singapore, Asia Pac perspective.
Yeah, sure.
Sure.
Sangeeta, is still there on the call?
Yes, I'm there.
Okay, Sangeeta, Danda, and who else from US? I don't see. Okay.
So we have East, West, and Central representation. So that's good enough.
Okay. Yeah, good. Can you guys see my screen?
Yeah.
Okay. So I didn't tie each of this to the EET or TEE. I'm still getting used to that acronym, but these are the different ways, but the order is the same, like Muruganan mentioned, right? So the first one is like traditionally what we do here is, it's also called traditional 401k. This is like your employer. So this is the employer sponsored retirement program, like any employer in US will have it. So this is a tax deferred, and this is a tax deferred retirement vehicle. It lets you to contribute up to 19,500. So that is a hard set dollar limit from IRS. That's the Internal Revenue Service, which is a taxing agency of US. So they set you a limit of 19,500. If you are less than 50, and if you are over 50, they let you do a catch up for extra 6,000, so that you can accelerate in case if you have missed anything. So the advantage of this is we will lower your income tax. For example, like if you are earning 100K, a direct tax benefit of 19,500. So you'll be paying tax only on 80K. So that's one of the biggest one. And all the contribution of free pre-tax. So that's why when you're withdrawing, you have to pay taxes, because somewhere you have to pay taxes, right? And I think the one thing missing here is the employer match. So I think close to 90 or 95% of US employer will match. I think the common thread is they match 50% of what employers are contributing. So as per this math, right? So you at least you're able to get 8K or 9K out of your employer, and that's part of your package. If you are not contributing this, if you're not leveraging this, you are leaving that money on the table. For example, if you invest only 10K, which is 50% of 19,500, they will give you only half of it, which is 5K. So that's why people in US maximize this. And this has changed over the course. So initially, every company had their own brokerage where you create your account and then they let you pick some funds, mutual funds. It can be conservative, it can be aggressive, but usually the returns are like around with bull market and with the dip, everything, it comes around 8 or 9%. But recently, as you see, the market is shifting towards like a aggressive mode and whatnot, right? So there are a lot of changes happening in employers' brokerages, traditional 401k. They let you take money out of it, put it in a brokerage account, and let you trade. So that's called a brokerage link infidelity. For Danda and Sangeeta, I know if you're aware or if you're not aware, please check that. That came to my knowledge only early this year. Like some of the 401k or lot of companies are what they started doing is they're giving more freedom to the employees, so where they can take money out of it and they can start investing any way they want. But again, with certain limitation, it changes company to company. The biggest problem here is these are the universal thing within among this vehicle, but every company has their own pact with the big brokerages, and it varies drastically from one company A to company B. Contribution of pre-tax, and you pay tax when withdrawal. So distributions has to happen. So you postpone it later, you will make a lot of returns. But I think around 15.5 is where you start withdrawing. So that's what traditional 401k. And apart from that, the IRS let you to contribute extra 6,000. This is a IRA where it's the same as the taxes. Everything is same as the taxes, but this is just a small limit. They have it. This is for the people who don't have that 401k. But even if you have 401k, I think you can add on top of it. So these both are like a pre-tax. So you'll pay tax later. And I think what Murugan, I don't know if you can relate to your acronym. So there's other way called the post-tax. So what they do is you pay tax for everything, and you do the post-tax investment on the same 401k or IRA, and there is a limit for that. So it's a little bit confusing. Like so the traditional way of 401k can also be invested in Roth 401k. That means you can do pre-tax 401k or post-tax 401k or combination of it, but everything comes to the limit of 19.5k. So the benefits of Roth 401k is you don't pay tax. You pay tax right now, but you don't pay tax when you withdraw. And Roth IRA is an additional 6,000k vehicle, but you need to be eligible for that. So putting into buckets, one is pre-tax, other one is post-tax. Again, people look at differently. People who are bullish on the market or who thinks they're going to be taxed to death in the future, they actually prefer, or I have seen whatever YouTube videos, they actually prefer or recommend Roth 401k, saying that you know what taxes you're going to pay now, just pay it, take the money out and grow tax-free, right? So that in future you don't have to pay a single penny, either you're doing good or bad on that. The other way of looking at is you have to do math on it, like how much you're saying right now, and then what your future is going to be, right? In US, like California is heavily taxed, so I'll be paying a lot of tax right now, and tomorrow I move to some other low tax state, then at that time I'll be paying less tax. So you have to kind of include all those aspects. So these are the.
Do you get employer match on Roth as well?
Yes. So that's what. That's also I found out. So the Roth 401k can be treated as your traditional 401k. Yes, you'll get the employer match. Yes.
Okay.
But again, it all depends on company. Company has to let you. Yeah. Good.
Usually
you had
you
a
don't
question?
get a match in your Roth 401k. The employer will match only in traditional 401k.
That's what Sagita. So what's happening right now is a lot of employers have combined pre-tax and also some employer also covering post-tax also. So you guys know about that 57K limit every year you can contribute, right?
Yes.
To the So my employer, I checked it. They can do either traditional or Roth, and also they do a post-tax also. So some employer will say you can't do Roth. Some employers say you can do traditional plus Roth or pure Roth. Yeah. So it's all again depends on things. So for US people, one thing I learned is all the brokerages who are having accounts or having pact with the companies who run their 401k programs, right? They have a very good support actually. So Fidelity is the biggest retirement brokerage here. You can call that number and just ask any question and they will be happy to explain to it, because each and every 401k program is different. So I know, Sagir, if you already done it, it's good, but you can call them and just clarify this also, because we have access to those documents within our employer portal, but sometimes very hard to read, or it's like 1,000-page document, right? So it's better to call them so that they can just go over it and do it. But some employers or majority of employers have started doing this. You can also contribute to Roth 401k and they will match. And there is another topic called rollover. So this is where that comes in, right? In US, what they say is for any individual, they let you contribute 57K a year or 25% of your income. So you first burn your EET, right? Your first phase, which is your traditional 401k. Then if you can, you do a Roth, and then some of the employees will let you do a after tax as well. So everything can combine to 57K. And this also includes the employer match also, right? So what happens is they let you do after tax. That means you are paying tax now, and then they let you invest in the equity market, and then you have to pay the capital gain tax. In order to avoid it, since Roth is a tax-free growth, you can actually do a rollover. We call it backdoor rollover, where you can bring in your after tax to your Roth. So it's actually very confusing, but even confusing for me still, but I can explain it in detail if someone is interested. But my point is, even if you do a post-tax investment within that 57K, there is a way to avoid the capital gain tax. You can actually reroute to Roth, which lets you do it. So pre-tax, post-tax, and it's a combination of it. And that's what it is. So anything you want to discuss in detail, we can discuss in detail. And there is another big subject in US or Western countries is there's a vehicle called 529 or a custodial account, where you set up accounts for your kids' education with a lot of limitations and very less returns. So that's a huge topic itself. I'm happy to discuss that later in a follow-up. So I hope this is what I kind of matched it. But yeah, Danda and Sagita, any comments? Yeah, any comments you can.
Thank you.
Yeah.
Yeah, I saw you covered tax deferred and tax exempt accounts. I think you should also cover HSA, which is like a combo of both. Because
that's what
the money goes tax free, it grows tax free, and you withdraw tax free if you're using it for your health expense purposes, which is a very good advantage.
Yeah, so HSA definitely, yeah, that's what, when we get into HSA, that's a whole different topic, right? But you're right. So I was planning to do it because I personally am not doing HSA. I researched it, and I think at this age or at this point of time, it may be a little too late to kind of contribute it, because you may use it immediately, right? The point of that is to build a pot, right? So, but yeah, HSA, I can definitely add a slide to it. Yes.
No, you can use it immediately, or you can also just, like you said, build it up for later, because you can contribute till 65, I guess, to your HSA.
Yeah, contribute. Yeah, it's the same related to what discussion we had, right, when Vinay asked, right? So I think it's ISA or whatever Muruganan told. So what here they do is actually, Sangeeta, when I talked to the financial advisor, he actually told that's the first thing we need to exhaust if it's available and if you're feeling good about it, right? So they let you contribute to that HSA account and they give you tax deferred, and also employer will also match, right? So it's more like in US, people. So that's why in US the taxes are for sure, and also your health cost, ridiculous health cost is also for sure. In US, health is a bigger aspect, so they have a vehicle for that, which is called HSA, health savings account, and your employer will help you with that. Yes. Yeah, I will add that, and I will do some research on that as well. Yep. Danda, any comment?
HSA, for HSA, not all employers contribute, like, no, so
yeah,
right, like,
that's what,
there's no
employer
contribution for that.
Yeah. So
but it's a tax-free amount which you can utilize for, like, no, medical expenses.
Yeah, that's true. So in US, right, so the tax codes are common across the states and across the country, but the investment vehicle, and even there's a state aspect to it when I talk about that 529 and all, right, the college education and all those. But it actually varies from individual to individual very drastically, because you have to really get to know your 401k plan and then try to understand what makes sense for you. So, yeah.
So one quick question, in HSA, can you access it for non-medical purposes if you have not utilized your HSA at all? And you don't need it for your health?
No, you cannot.
You cannot. So that's the whole point.
No, you can. No, you can, but you have to pay penalty if you're using it for non-health related expenses. If
it's the same.
For health, you don't need to. But if you can use it after 65, it becomes like a normal account. You can withdraw from it. But if it is not for health related purpose, you'll pay some taxes on it. It becomes taxable.
So the point is, like, they will get the taxes out of it anyway. So either way, So
that goes without saying.
That goes without saying.
Conscious of time, as well as the number of people from India who have joined. Any comments from anybody from India? Vijay, anything that you want to comment on?
Just one quick thing. So since India is the largest audience, right? So I know, like, I'm just putting you guys in spot, but if you guys can discuss anything which is relevant, we'll also learn, and also I think majority audience will also appreciate. So sorry, Muruganan. If Vijay or anyone else.
I was going to make the same comment, so thank you.
So I have a quick question. So what if you have an account in IRA and 401k, and then the capital grows considerably because of the bull run, right? And I don't want to park large amount of sum over there. So I want to withdraw and roll it over to Roth. So what is advisable there?
So since you're still part of your employer 401k, right? So traditional to Roth, I think that conversion is impossible or cannot be done, I guess. So the only way is, so for example, when you worked here, who is your brokerage, if you don't mind? E-Trade or like Fidelity or Schwab, or who is that? Fidelity, right? So what you can do is, so you do you know understand do you know the difference between 401k and IRA, right? 401k is employer tied, right? Very limited access to the fund, so that's what you might have right now. What you can do is you can open an IRA account and transfer that 401k to the IRA, so that you get more freedom on investment. So you can even trade stocks, and you can just do whatever the way you want. But again, taxes you have to pay when you withdraw. So you can't convert right now. You can convert if you're ready to pay the taxes and come out and then move it to Roth.
So that means if IRA account grows considerably, and I'm not comfortable keeping it there because of the bull run, right? So So then I can withdraw the amount by paying a penalty. That's 10% penalty, and I can roll over it to a Roth and put it in a.
Yeah,
right?
yeah. I think that's possible. Just check with it because if it is a very considerable account, yeah, definitely you'll have to pay penalty. But I think there's a possibility where you withdraw it completely because you already paid taxes, right? So then I think at that point, okay. So the another thing is the Roth 401k your employer has to offer. If you're not employed here, that will be a tough one. And Roth IRA has a limit, hard set limit called 6K. So let me do some research and get back to you. Srini, right? Srini,
Yeah.
I'll get back to you. Yeah.
Yeah,
but,
because all this are all virtual money, unless because we're not enjoying the fruit yet, right? We're just seeing it. It's all virtual money there, right?
See, no, that's
happens,
the whole point.
No,
that's the whole point of retirement, right? When we first see, that's what I was discussing with Murugan. If we discuss this in our 30s, no one would be attending this call. I'll bet you, because no one cares about it. But right now, we see the value of it, right? So you're right. It's sometimes boring, but that's what governments make you to think about it, because in 50s and 60s is too late. Oh, I should have done it, right? Because when people come to US or UK, the first thing they think is I'm not contributing anywhere because my money has to go to India. Then you already missed that 3 or 4 years of initial investment and all those, right? So I see what you're thinking. But also you have to do some analysis. I know bull run is there and all those, but why can't you move it to a traditional IRA and keep it growing, right? If you really want money, you pay penalty and get out. If you don't want it, let it grow. Like, in your case, because the tax
actually,
and all
those.
It's
in IRA, traditional IRA, yeah.
Oh, you're in traditional IRA, right? So then you have freedom to choose any investment you want, right? Yeah. But if you want to,
guys, I have to interrupt. Let's move on. I think we're losing people, so let's move on to the core of our discussion. Okay, so guys,
let's target India.
Any comments from India? Otherwise, I'll jump on to the other part of the presentation. Okay, I'm going to share my screen again. Hope you can see my screen. Let me know if you can see my screen.
Yes.
Yeah. Okay, so this is an Excel sheet and it might look a bit confusing. It could be overwhelming. Bear with me. I'll explain the layout of the Excel sheet first. So I've got a few sections, 4 or 5 sections. So the section on the top left is wealth protection and accumulation, where I capture everything that I've got today, everything that I'll be having, between now and before I retire, and also all the expenses. So like I said, these numbers are all dummy numbers modeled around my portfolio, but not exactly my portfolio. I had to bring in something to, drive home the point and land the message. So that's one section. The section below is wealth distribution. That's post-retirement. Section on the section in the middle has got some comments. Most of the comments are already covered. And I've got a little section on inheritance, and then I've got some analysis. Okay. So my starting point is here, right here. That is on F27. So at the age of 60, when I retire, so for me, 60 is possibly when I can retire. There are many reasons why it's 60 and not 55. My desirable age for retirement is 55, but the way things are lined up, my mortgage, commitment I have in terms of children's education, marriage, a few other things, they're all lining up more towards 60 than towards 55. Between 55 and 60, if I have to retire at 55, then I have to do something substantially different, radically different from what I do today. And it doesn't look possible, at least at this juncture. So I start at 60. So the first question I need to answer is, how much do I need? How much how much a retired couple like us, me and my wife, would need at the age of 60? So today, in today's terms, we will need about 40K to have a decent retired life in today's terms. And 40K today would mean 65K in 15 years from now, taking into account inflation, the effect of inflation, which is about 2.5% here in the UK. 2.5% is a number that is widely used for inflation purposes here in the UK, right? So So I start at 60 and then I will add 2.5% year on year to see how much I need year on year from 60. And I go all the way up to 100. Okay. Now I then look at 3 options I have at the time of retirement in terms of getting a monthly sort of income. One of the options is you go into a full annuity plan, right? So all the wealth you have at that point, take 25% out, put that in a pot, put that in a saving that you can, saving plan that you can have at that time, considering a risk appetite, which would be very low in your 60s. So put that in a saving pot and use it for emergency or for withdrawing for a shortfall. And the rest will be in an annuity plan where you get a monthly sort of pension from the annuity, a fixed annuity. And again, in annuity, you have various options. You can have a fixed regular monthly income. You can have, income adjusted for inflation, so gradually increasing. You can have annuity for yourself and then your spouse and various options. But depending on which option you choose, the number may increase or decrease. If you go for the most productive, you get paid, your wife gets paid, and then you get a lump sum at the end of it, then the monthly you get is very, very less. So that's one of the options. The other option is you do a complete drawdown, take the whole thing out. Treat the whole thing as one pot and you draw down little by little whenever you need it on a monthly basis. So that's option 1. Option 2 is full annuity that we first discussed. And option 3 is a hybrid option where some of it you discussed in an annuity plan and the rest of it is discussed, rest of it is parked in, investment plans, savings plans from where you draw down on a regular basis, not as much as you would draw down on a full drawdown, but partly, and the rest of it will be invested for some sort of decent returns. So on the, and I asked myself till when I want this sort of financial protection, till when I want to be supported. And the answer in my mind was I want to be at least covered up to 90 years. Okay. Now I know for a fact I won't live until 90, but nothing is in our hands. But if I do live until 90, I don't want to be financially crippled and I don't want to be dependent on somebody else. So I want to be self-reliant. Okay. So up to 90 is what I would like to plan for. So column I, column L and column O would show that if I have a pot of about 2 million, little shy of 2 million pounds, I can sustain on a drawdown pot until 90. And on the other 2 options, slightly worse off, right? On the other 2 options, it'll be 87 and 85. So little slightly worse off on a full annuity or a hybrid annuity plan. On a drawdown, I can last till 90. So to retire comfortably, and I have also taken into account the state pension that kicks in, from at some point around the age of 70. I also have some retirement-oriented, I'm sure all of us have some retirement-oriented plans. So I've taken all that into account. Given all that, I need a pot of 1.9. I then started reverse engineering to see what I've got in terms of various investments today and which pot they're lying in, and what other milestone incomes I've got, what other investments that are maturing that I can access that will be, that will mature, that will come in. And I've also listed some passive income that come in the form of rental income. And I've also mapped all the expenses. So put all that in one place to see if I can get to a pot as close as possible to what I need to retire comfortably. Now, what I'm doing here is like the way we assess the company's performance, the fundamental analysis we do to invest in a company, where we look at the balance sheet of a company, we look at the profit and loss statement of a company and a cash flow statement of the company. All 3 are very, very important to indicate how healthy the company is, how much future proofing they've done, how strong the fundamentals are, if there is a company worth investing. I've taken a similar approach. So I'm saying, my assets have to match the liabilities I've got, and my incoming should match the outgoings. And I should have profit and loss aspect on my investments. I should look at the optimization of my investments to ensure I get maximum possible returns, playing by the risk appetite that I've got, playing by what I know about the various kind of investments. At the end of the day, I should have control over it. I should definitely know what I'm doing. So that's a profit and loss statement. And the most important aspect is cash flow. How do you manage your cash flow? So we all are very good at managing our monthly cash flow. We know, from what we earn, we will spend, we will save a bit, we will also pay our mortgages, pay all our bills and everything. But what about cash flow on a continual basis? How have you planned for children's education, marriage, the family? Any medical expenses that we might have for our parents, elderly in the family, anything else that could be big in nature, and how are you planning to, manage that cash flow aspect? Because the last thing you want to do is, in spite of building a wealth, if you keep taking short-term loans, like I said before, then it actually sets you back. It will, create cracks in your whole investment strategy, right? So how do you manage your cash flow? So that's the way, I looked at it. And like I said, the whole thing was brought into this sheet to see how much I can build potentially and what the gap is and how do I now bridge the gap. So there are only 3 levers to bridge the gap. You can either maximize your income, easier said than done, but somebody asked before, what kind of passive income can I create? Maybe somebody in the group can answer, or we can discuss in our WhatsApp group, or we can discuss on the follow-up call. But there is that lever where you somehow find a way to maximize your income, either by creating another passive income or even an active income. You got to minimize your expenses. Again, easier said than done, but that's another lever. You can see how we can smartly, reduce the expense of children's education if you plan well in advance. How you can plan, how you can cut down your medical expenses by having some medical insurance pulled out right now than later, and so on and so forth, right? So that's another lever. And the third lever, which is where we have maximum control, and which is where we have to actively get involved, actively do something about, and actively rebalance is, return on your investments, optimizing your investments, and ensuring they are lying in the right, buckets. While you've diversified, while you've put the eggs in various baskets, also make sure they are yielding the right returns. In my case, for example, I'm very conservative in the sense any lump sum I get, I always park in TTE, in deposits, and I will be drip feeding that into equity over time. That is actually working against my wealth accumulation, right? It's working against my retirement sort of objectives. That way of building wealth isn't going to bridge my gap. So I have to definitely change my tack there. I have to look at maybe going a bit aggressive on any sort of investments that I do in future with respect to lump sum. If not invest all 100% in equity, maybe have more exposure into equity and less into deposits, and so on and so forth. I've got at least 1 or 2 properties that I know very well are no longer appreciating, and I don't expect them to appreciate. I've also seen from my experience, especially after my dad passed away and left 1 or 2, lands with us, which we just unable to sell, and we don't even know where they are. I know some properties are like that. So do I want to take a call now, or let it rot and then become absolutely, next to impossible to do anything about it later? So those are the kind of calls I have to now take to bridge the gap that I've got. The gap is about $500,000. It's to be honest, a lot of things are overstated here. The expenses are overstated. Return of, I've indicated the percentage at which I expect each, bucket to sort of appreciate. That's understated. So there is a bit of going aggressive on expenses, forecasting very high expenses and forecasting very low returns. So that gap is definitely overstated. It could probably be half of it, 3/4 of it. But there is a gap, and I have to do something about it. And it is now down to the way I manage my cash flow and the way I manage my return on investments. So that's a point that we want to drive home to sort of, one, look at the whole thing in totality, create this distribution first, come up with what you need from when you want to retire and how much does it increase by year on year, and see what sort of pot you need for sustaining that, to support that. And then does that pot look achievable with what you've got now? If it's not achievable, what sort of interventions do you have to take? Does that mean you'll have to create another, 1 or 2 more, streams of income? Do you have to relook at the expenses planned right now? Do you have to now, do something about your portfolio and change your way of going about managing your portfolio, and so on and so forth. So that's the way we looked at it. And when I socialized this with Raj and Kamal, they also felt it's useful to bring them all in one place and then look at where the gaps are. And pause there for comments and questions. There isn't much to cover here in terms of comments that I've got here. We've already discussed. There's a bit on inheritance. It's just that I think it also helps to have a view of what you are going to leave for the next generation. And you may probably think you're leaving a lot, but if you put a value to if you actually take into account the value of money in future, it may not be much. So it will help to know what sort of inheritance you're going to leave for the next generation. And this is the one I use for knowing what sort of strong base I've got and how much of. So the base here is all very conservative investments. The middle layer is where property, gold kind of investments go in, and top is the equity exposure. In my case, some people will have the apex of the pyramid as high risk investments, collectibles and maybe gambling or that sort of thing. Some may invest in some very, very risky places. In my case, equity is riskiest, given my risk appetite and my knowledge. So that's the apex of the pyramid. Clearly, as you can see, my base is strong, but I've got a very less risk-taking appetite. So I have to do something about it for me to get a decent pot. So that's the analysis here. And the one below is a cash flow analysis of how well I'm doing from now until I retire. Comments?
Hey, Murugan and Arun here, a couple of questions before comments. This expenses, what you are showing, that is including mortgage or excluding mortgage?
So I haven't included mortgage because mortgage is covered in my monthly cash flow. These are my milestone expenses, so to speak. So like I said, my monthly cash flow, I'm assuming, at least in my case, what I've assumed is my monthly cash flow will take care of mortgage, bills, and also I'll have something available to invest every month. Okay, and that investment is brought in one of the three buckets here. So if you see my column G, it wasn't this good before. One of the interventions I've done, one of the realization I've done, I've had, started looking at it as I should step up on pensions. I should go full on. I should, go as close to the 40K investment into pension by hook or crook, because 40K, if I don't do it, when it comes in my hand, it will be taxed at 40%, given the high tax percentage here, tax rate. So it is not actually as much as 40K, it is less than that. So that's one of the, things that I will be doing on a regular basis. That's my monthly cash flow. But I've also assumed that I'll be able to do some direct equity investments year on year, again from a monthly cash flow. So mortgage, to answer your question, is not in the column F, at least in my case. Yeah.
Not in that. Okay. And the second question I have is that the target pot, what you have is still with an assumption that you will only draw from the returns of your investments, and the capital is not fully touched in that sense. The capital remains as is, you only draw on the returns from it. So you will leave behind the complete capital as is, or?
No, the capital will drain.
Will drain, and still this kind of a buildup is needed.
Okay. Yeah. Mm-hmm. In India, I know an annuity plan, you can invest a capital, get a monthly pension, and also get the capital back. That doesn't exist here, to the best of my knowledge. My my friends here in UK can correct me if I'm wrong. Anand and Ellen, feel free to comment. I don't think in equity you have that option here where you get the capital back. I don't know about the US. That's not an option. If you want to take that sort of route, then you'll have to probably look at investing in a property kind of investments to retain the capital and just get the returns.
So if I understand it like this, the day you hit £2 million pot, say you take a retirement, and then between the retirement until the age of 90, you will consume that pot in total.
Correct. Correct. Yeah. That's my way of modeling.
You're not
I'm
slowing
not saying
down,
this
man,
is
after 60 there.
no, I'm not saying this is the right
joke.
way to go about. I'm not saying this is the right way to go about, right? I'm only saying this is my way of modeling, right? See, I'm pretty sure I won't take that route. I'm pretty sure I won't do anything much to the property. I'll probably leave the properties to be rent yielding. Okay. So this is a real worst case scenario where you dilute everything to something.
No, the model is good. I mean, I'm just joking that you don't slow down even at 80, 85. You keep doing what you do in that sense. Okay.
Yeah.
Murugan, and I have a question. Are you taking inflation also into account for your withdrawal calculations year by year?
So, yeah, correct. So in this column F, I've shown my retirement income requirement to be increasing by 2.5%, which is the inflation number that we use here, right? And if you look at the drawdown option, I have let my investment, I mean, whatever is left in the pot, appreciate between 1 and 2%. It's slightly different if it's 1% and slightly better off if it's 2%. So whatever is left in the pot will appreciate by between 1 and 2%, and the income requirement would go up by 2.5%. Does that answer your question?
Yes, but I'm thinking like 2% is too low, right? I mean, you can be on the
Well, I mean, at the age of 60, I mean, even today in the UK, if you get anything more than 0.25% on your simple savings, you're lucky. It's in the range of 0.25 to 0.5. At the age of 60, your options are limited. Your risk of credit would have come down quite a bit. And again, like I said, it's okay for me to understate my return on investment and overstate my inflation, expectation, because I'm then planning for the real worst case.
So you are planning to keep everything in fixed instruments, you mean, when you're retiring?
I am not. I mean, I've got no concrete plans for what I want to do in 60. I'm only saying in the real worst case scenario, if my risk appetite at that time is very low, I don't want to be having any exposure to the market, very limited exposure to equity and market-linked investments. And I want to keep more and more in debt, which is what the conventional wisdom is, right? So, you talk to any financial consultant, they will say move away from equity and approach the 60s, and then come off as much as possible. Between 60 and 70, you'll be diluting quite a bit from equity, and by 80, you will have everything moved into, late 70, early to late 70, you will start moving away from equity, totally. Because you can't wait for another bull and bear phase to happen, and for long-term returns to be given back to you. So I'm assuming a very conservative return on investment from that point on, and a decent inflation from that point on. But in all probability, that return is going to be higher, and inflation isn't actually going to be 2.5% year on year. So in which case, I will be able to last longer, or I will be able to even leave a legacy for the next generation. The pot will not be completely drained out. Yeah, is it fine?
Yeah, but I was thinking like, what to say, like something like laddering you should do. You shouldn't come out of equity fully even when you retire. I mean, it depends on each person, but my point is you have at least 30% invested, because you're not going to need all the money in the beginning itself. So maybe
so
for first
you can play around with the numbers, Sangeeta. No, I agree with you. I totally agree with you. No disagreement whatsoever. You can play around with the number. You think 2% is very less, increase that to maybe 3 or 4 or 5%. You will then see that you can last a lot longer. You will even be able to, if anything were to happen to me, if I were to consider a 5% return on investment, if anything were to happen to me, as you can see, even if my previous plan, I depart at the age of 90, I leave a 3 million sort of legacy to my, family. Right? I'm only saying I would rather want to plan for the real worst case scenario now and hope for the best case scenario. Any other questions? Does anybody else find this to be too cautious an approach or too sort of not so well balanced? See, I mean, to answer your question again, Sangeeta, so even here, if you see, I'm saying my pension pot appreciates by 5%. I have at least seen a 10% appreciation on my pension pot so far. Again, I'm conservative here. I'm saying properties will appreciate by 3%. It depends on where the properties are. If the property is in the UK, there is hardly any appreciation, 1-2% maximum. In India, it used to be very high, but now 4-5%. On equity, again, I'm saying 8%. I definitely know I can do better. On deposits, I'm saying 3%. That again could be higher. So it's all conservative returns assumption and slightly overstated expenses, just to ensure that I am planning for a real worst case scenario. Sorry, I'm repeating that point, but just to land that message.
Yeah, I got it. I am like a person who like to see even the good case scenario because it will keep me motivated. Because if I see only like what's going to happen worse, I might give up. So that's what
I have a sheet. I actually have a sheet that has the worst, best case scenario or a more pragmatic, practical scenario. So it is not alarming. I won't fall off my chair. I won't, fall off a cliff if if the way things go the way they expected to go. But like I said, I would rather want to have always a plan for the worst case scenario. But I mean, we can catch up, Sangeeta. We can catch up. I can walk you through the best case scenario. Like I said, model around my portfolio, not exactly my portfolio. If I bring in all the details, maybe already get rich. Again, if I change these numbers, it'll be a better scenario. But it's the approach that we're talking about here.
No, so worst case or best case, right? So there's the financial planners always will present you what is that, the median, right? So the median is what hello,
correct,
can you hear me?
Correct.
Yeah so
correct. Here in the UK, I know in India, whenever they show you any investment sort of options, they give you for 3 different percentages. Here in the UK, one of those percentages is actually -2% or something. They are supposed to tell you what the worst case is. Because that has happened in the market, that has happened to people. A lot of people have, especially those who had faced 2 or 3 recessions, have seen the net worth decreasing over time.
Yeah. So that's what 2 things can be like. Instead of worst case or best case, we look at median, right? And the other one is a 10 percentile, which can be the best, right? The best of it. So, but again, in next 10-20 years, like 8% equity can be laughed off, or I don't know, because everyone is still hung up with 8 to 10%. But with the bull market going on, right, we may be at the better higher of 10%. But again, this Excel sheet will let you to play with that, right? You can change that percentage and then see the impact immediately, right? So how it works. So, yeah.
And then Raj has got a beautiful tool, a tool that he uses to do something similar. So on the tool, you have much better leverage on changing the numbers. I still haven't experimented on that tool, thing to do. But it's more the concept, more the approach that we want to socialize.
Yeah. So I'll just quickly share that. I know it's only available in US, but it's more like thinking of. Can you guys see my screen? No.
No, I'll stop sharing, Raj.
Okay.
Yeah, it's there. It's there.
Can you no? Can you see it? Or?
Yeah.
Okay, so this is something, it's getting very popular here. I think most of the banks also offer it, right? This is the same and this is a snapshot. So, what is that, internet image. So it's more like what he has put into perspective, right? So this is a nice looking tool, but it's more like what assets you have, what liabilities you have. You bring in your cash, investment, credit, and all those. And then over the period of time, you can see how your net worth is going up and all those. And you pick any life event and then plan for it, and your retirement saving shows up here. So this is all what the detailed Excel sheet will have, but you can think in that direction. So cash flow is your income minus your expenses. The budgeting can go as detailed as your gas bills or your petrol bills, and then what all having it. Because in Western countries or in everyone plans about that emergency fund and all those. So you can have a whole holistic perspective from this is just the cash flow perspective. And the same tool will also will analyze your existing retirement thing. And this is what it gives. You have to just input your income percentile. So they always give you the worst and the best, not worst, but at least the median and the best case scenario. And to Arun's point, you have to get into your, your capital. And when you're withdrawing it, that's why the graph just, it peaks at your retirement age and then it eventually falls down, because that's how the model works. But if you can avoid tapping into your capital, that's fine. But generally, any retirement model, it always starts with this. It'll just ramps up to the 60 or 65, and then you started withdrawing. You actually withdraw from the capital and also from the profits, whatever you made. And this is the whole point of, So
if you can retain the capital and just get the returns from the capital, sustaining, helping you to sustain until something happens to you, that is a fantastic position to be in, Arun. That is like amazing position to be in.
That's a different thinking, right? So when we think about investments like gold and real estate, that's what we want, right? Real estate, in sense, we get the rent forever, and you don't sell the capital, right? That's the same with the gold. You may take loans on gold, but it can just keep you as long as you want, and you pass it on to your next generation. But when you come to equities, when you come to those investment, I think this is what more realistic. I think so. But if you're really lucky, if you're putting in some high return annuities or something like that, you can still live on returns, but your capital can grow. But yeah, that's a possibility. But most of the Western models, whatever they project, or even in India, right, when you talk to financial planners, that's what they see. It actually tapers down once you hit that your age. Yeah. So actually, some of the banks are already started giving this. Danda and Sangeeta, you can check your existing Fidelity or anyone. They already have some kind of tool already available. You don't have to go to this personalcapital.com and build something. And same with, I think in India, like if you're having like the best of the breed, right, like ICICI or HDFC, they might also have this holistic view of it, because everyone wants to understand it's more like giving the free software and trying to gain knowledge, right? It's data we are selling, they're gaining data, right? So it's everything about data right now, so that they can perfect their model and they can pitch their sales to you, right? So
does Fidelity gives, Raj, this one?
Yeah, try Fidelity. I think Fidelity gives you, but see,
is it part of our investment site itself, or a separate access needed?
No, so that's what I'm saying, right? Everyone gives it for free, because you're gonna, the only, not the catch, but the only thing people is wary about is you have to log in, you have to give your credentials, right? If you want the true picture of it. So in this, if I want true picture of it, I have to give them credentials of my Fidelity, right?
Which I'm not convenient, which I'm not comfortable doing.
Yeah,
I'll send you something, and I have found something that I'll send it to you, right? I mean, for me, it started with a financial consultant approaching me with his own tool, and I gave him limited information. I didn't want to give him full details, and he built something like this, and he rattled me, completely by showing me that I've got a huge gap, from when I want to retire, which anyway expected, but not to the extent he had shown. And that's when I started building it on an Excel. I'm soon going to migrate this onto a tool that I can manage in a better manner, and which would also allow me to do the practical scenarios. But I found a tool. I'll send it to you and I'll send you the details.
Sure.
I won't rely on
the. Sorry. No, Raj, is this a chargeable one or
no? So see, that's what all the financial advisors are doing, right? So that's what, when I told you, call your brokerage or you call your 401k, like in US, or call your the financial advisor, right? Right now, the business model is simple, right? It's same like the old razor blade model or printer cartridge model. They'll give you the hardware or they'll give you the software in this case. They will get all the information and then later they'll try to pitch you in, right? Like Murugan told, they may scare you or it might be the reality, right? And then they'll say there's a gap here. So why can't you think of investing, right? So that's how it is. But there's no charge initially for this.
Like insurance company giving Fitbit free.
Yeah, that's what, same, right? Yeah. So they gave you cartridge they gave you, still printers are like, you can buy for $20-30 in US, right? Huge printers, but the cartridge is like $60. What the heck, right? It's just a small piece of, it's the same. So they give you the tool so that it gives you the perception of what you want, and then they'll do the sales pitch. But it's simple, right? You can build on your own on the Excel. It's about all your assets and liabilities. So you have this picture. And then based on Murugan's Excel sheet, if you can actually build like this with all the variables, right? Like your age, your inflation, and your strategy, you can actually see this. You can actually build it. It's nothing but everything is about data, right? So it's all about, it's a simple graph, but the data is what matters, right? For some people, it might be different. It might look, and also these all the variables, right? How much you want. Because every time I see in this model that people say I need 100K to retire, then coming from India's conservative approach, 100K is a lot of money for people to retire. But that's how the Western lifestyle is. So I go to vacation, I go somewhere, I go cruise and all those, right? So that's all factored in. But that's why your Excel sheet gives you more leverage if you build, so that like after retiring, you go back to India and just sit and you don't even worry about that. So that's why I think your thinking is also coming, right? Why do I need to drain the capital? Because I'm gonna be okay with the returns. Yeah, that's totally fine, so that your capital can stay afloat, right? Because in this model, it's saying you need to take vacation, you need to go around the world, you need to do whatever you want. But if you're not doing that, you can still keep the capital intact. Yeah. Because your returns will definitely help you. Yeah.
And Murugan, the other question is for the hybrid model I mentioned in the beginning. Have you considered your assets and savings in India to be repatriated into UK if you want to settle down there, or what is the assumption there?
For the model, I've assumed everything, but practically I know it's just impossible to bring anything from India to here. Maybe, it's possible to take money from here to India, but I don't want to bring anything from India to here because it just, I'll be digging a grave for myself, taking my own.
Technically, this means technically we live until we drain the money here and then go back and continue the life in India with the rest of India.
Yeah, it's so I've taken everything into account for the modeling, but when it comes to actually cash flow management, I have to, take a hard look at it. I have to revisit and do better cash flow management, because I know for a fact it's just not possible to bring money from India to the UK without getting heavily taxed for it. And then it's like opening up the gates for the governments to know what I'm doing on foreign soil, which I don't want to do.
Yeah, mainly for people like us.
When it comes to insurance management, I have to take that into account, because if I were to leave my family in dire straits, and if they don't have access to funds from India, then I have to have protection here in this country. Especially if they're going to, if my wife is going to wait for my daughters to finish their education here and settle on their own before she decides to go back to India, then there must be protection in the form of insurance, at least until that time. So it's a good point. It's a good question. It needs some work to be done. In my case,
the hybrid people like us, in the initial years, we pushed a lot of money into India, and slowed down, and then started thinking maybe I should not send too much now, maybe I should save here, that kind of. So you do have a critical period in which money was exported, right? So, and then you start rethinking about where do you want to settle, kind of.
To answer to your question, and my view is whenever I think the 2004 to 2009, whatever I earned, I put it everything in my hometown. Today there is no return. Then 2009 to 2015, I invest in Chennai. It is little bit, but 2015 to 2020, whatever I invest in UK, it is crossed above whatever I'm getting in my hometown in Chennai. Exactly. So wherever you're living, focus there. Unless your visa criteria is coming, visa you can't move it, then probably.
No, I mean,
it's
that's the
slightly
same
different.
anxiety, right? When you come first time, you normally think that, okay, I don't know if we will survive here. It's a, it's a strange place. Okay,
Yeah.
2 years, 3 years, slowly it increases. When you know to live in minus 25, you then get used to it.
No, I don't. That's actually given for almost all the Indians, I guess, who living abroad, right? When they first come, it's the preference always at back home, right? That's why I told, like, when people come here, get their job, they don't even contribute to that 401k or anything on the first year itself, right? They'll say, I'm going home, why do I need to save, right? And then slowly, you realize that. But that hybrid thing is a little bit very scary. I think, yes, there was some discussion about it, how to get money out of from our India investment and bring it back here. But we have to do a lot of analysis, right? Whether it makes sense to do that. And that's a whole thing, which I haven't even thought about it. I know it's very tough.
It's a very off-putting thing to think about.
But every year I go, whenever I go to India, I have a plan. I need to set 1 week aside for it. As soon as you get to India and you see that thing, right, you will say, okay, let's handle when it comes, right? So Murugan, as you said, there are some,
to get rid of property.
Some of the lands your dad has bought, someone is going to enjoy it, not us. So it's gone sometimes, right?
I mean, let's be very, very clear, right? Let's be absolutely, clear and truthful about it. We're not going to let each government, I mean, the other government know what we've got on the other side of the fence, right? So
but that cannot be avoided. I think that's already started. Like whatever India is doing with UK, US, and all those, it's already started. I think Indian government will get hold of, or they will have a complete view of your financials. I think so. Eventually they will get to know. Yeah, you can't.
Okay, so it's almost end of 2 hours. So
it's a quick
any
question
last
on your
questions
spreadsheet. A quick question on the spreadsheet. If you open the spreadsheet, you plan for 2 million for your retirement kind of thing. I see the pot you mainly invested in equities, pension, and the property bit in India. I'm just asking the general idea. What are the other things are there? These are the common things very safely to pay. Is there any other things are there? The bigger picture to see. It's my personal, the other risk I see in your spreadsheet. What I'm hearing, in 10 years time, digital currency is going to be makes more dominate. What will happen to your investments? You will be getting the same returns if the digital currency comes.
Don't know. Good question. I don't have an answer. I wish I had an answer. But I'm not evolving as fast as some of you are.
But those are all investment vehicle, right? But I don't know how crypto can fit into equities. Or...
No, I'm not coming into crypto at all. I'm just asking.
No.
But put it collectively. What are the other modes are there? If the digital currency dominates, these 3 or 4 investments you are looking for next 25 years. My view is any investment don't keep more than 5 years. If you see the good return, take it out and go with the flow, new flow. Invest that money. Bring it more. That's where I see high risk. This is highly high risk. You're not keeping anywhere. But the 2 million, if you want to make it, you are thinking 20 years time, I'm going to get all these 4 effects. That 4 is not there. Something new come. It's gone.
No, very valid point. But you're right. As of now, I think most of our countries, whatever you're gonna save, it's gonna go back to equities only, some way or other, right? Either it's mutual fund, either your own equities or any ETFs or something like that. It's gonna go back to the Wall Street or thing, right? But that's that you can have a separate column where you can do it like we have it for property and gold, right? So there can be like a, I don't know, like whatever the additional investments, right? So
one thing I see is if you want a retirement for 3,000 pounds or 4,000 pounds, in current status, if you have 2 property in UK, you're done. You maintain 2 property for next 20 years, you're getting you that money.
No, but that's what that confidence you have in the property market. Why not in equities, right? So that's another argument as well, right? Because properties.
But if digital currency goes, property market won't impact, but equity market can impact. I don't know. I'm just
the variable. Yeah.
No. it wasn't so much about where the money is invested. It's
about
the main driving point was maximize, minimize, and optimize. That's maximize income, minimize expenses, and optimize your returns. How you do it is completely up to you. Again, we can have follow-up discussions, and we've been having a lot of discussions on our group. Continue doing it. But there are many ways to get to what you want and more than what you want. Let's all help each other as the point that we want to drive home.
Exactly. That's why I want to get a general view. Other than these three things, do we see anything? We don't need to discuss now. At least we can think over and come back. What are the other things, high risk or low risk, other aspects of investment we can do it for long term to get it. In parallel, if we put 7-8 tracks, it's easy to meet our criteria. If we keep only dependent on 3, something happen in the world. If you're not getting enough, then we're gone. That's what I was thinking. Anyway, it's a good plan. I think you put a lot of time to put a detailed thing. I never tried, but I have everything view in the high level in the mind is what I'm doing it. But it's good to get everything in a single place.
No, actually, that's the whole point of this, right? So everyone knows, right? So, and again, sorry to like kind of raise alarm saying that, but we are getting old, right? So it's like we have to be. And again, when passing on to your better off or even passing on to your kids, right, the knowledge, right, if you have something like this, it's very easy to explain and also pass it on and also make them interested, right, rather than you list it on a paper saying that here is what all we have and all those. So that's the whole thought of this, because everyone, I bet everyone has some piece here and there and all those, but it's putting everything in that perspective and also start thinking in that direction, right, because so that's the point of this. And
the last one is kind of whatever we are planning for future, the retirement kind of thing. It is all materialistic. Beyond that, something you need peaceful happiness that we have to bring it. Absolutely need a meditation. If the meditation is not there, or some form of thing, yoga, meditation,
and a health.
Otherwise, it's not going to work out. Whatever you make it.
Murug says assume that it is part of his life. For many of us, not. So you are right.
This is all planned very well. I have everything, 2 million, everything.
No, but you also
I'm happy.
you have to also remember Murug is also our fitness trainer. So he also values health equivalent to our wealth. So
it's not only him. Generally, I'm saying. So that's something needed.
Just saying like
man, it's not enough. Something needed, peaceful. That we have to
that's totally materialistic is what that's the topic of today's discussion, but we are open for that. So that's why after 60, right, it's all Rama Govinda Bhajna stuff. So
will you slow down at all, or will you not?
We'll go to Kedarnath, we'll go to Vaishnava Devi temple, definitely, but
and become another Talaivar.
Okay, that is 70. Don't worry, that's a long way to go.
Guys, so sorry to interrupt. Do we need a follow up? So give your feedback on the WhatsApp group, and if you want to follow up, I'm very keen to hear from Tamil and others. Anybody in the group wants to volunteer and run the next session, share with us what you're doing. Anand, I'm very keen to spend some time with you and find out what how you would go for building this, and maybe if that is something you would like to share, that'll be useful. Definitely from Tamil. Anybody else want to share anything on how you will go about optimizing your investments? Feel free. Put your hand up on the WhatsApp group. We can have follow-up calls happening. We should have these conversations going on a regular basis. It should be at least twice a month types. I think we can really support each other and help each other.
That's what. To add to it, right? Next section, definitely, I would. This is my suggestion, Muruganand. Like, if we can get some from India's perspective, right? Like Vijay or Tamil or Sundar or anyone, right? Who is really well, because you set the stage, right? So we can have the next session purely dedicated to that. And then we may have to, I don't know whether it's a good idea to break down by countries and just a little bit explore it, because that makes more relevance, right? When we talk about any country specific thing, because there's a lot of questions, a lot of discussion can happen. But next session, I think, we'll have someone so that they can share their perspective from majority from India side, right? So that we'll also learn, because we'll also understand what has changed there, right? So that's my suggestion. What do you think?
No, I agree. Totally agree.
Yeah. So then you have to get hold of Tamil. She understands. So she already talked to her. And again, if someone is interested, definitely, yeah, they can step up and yeah. Okay, I see Vijay being very silent about it. So Vijay, what's happening and who all is there here?
I'm a silent learner today.
Okay. Okay.
Lot of good stuff. Lot of good stuff. Mega plan.
You might be thinking, whatever I invested on Friday is going to give that return on Monday. Why have to worry this session?
That's what it looks like, right? Yeah, that's what
is it true, Rajay?
Like I said at the beginning, some might find it to be intimidating. Some might be like, what's the big deal about it? Why are we even spending time on this? I've already I've got all bases covered. It's nothing for me.
Yeah. So it's more like a checkpoint, right? At this age, right? Just more like checkpoint, because even before we starting this discussion in our group, right? In my local group, we all started and everyone started contributing and started discussing, right? So it's more like, at this stage, we just definitely have to take a look at it. And as you said, like either you take it or leave it, it's up to you. But there are a lot of factors which we need to consider, because our earlier generation didn't consider, and few of them has learned it in a hard way, right? Because it's always been granted. The knowledge will definitely pass on in the due course, but not like this, right? But again, it can be intimidating.
Some of our earlier generation probably did not think so much, but still managed in a better way.
It's foolish to think it's going to be that way in future. I don't, at least in our generation, because there's so many uncertainties.
No, that's right. I'm just giving credit to
I also like the
earlier
fact.
generation.
I also like the fact we kind of digressed a bit into insurance, especially medical insurance. So like Raj said, we've set the scene. The stage is open now. All those factors matter. Everything either sets you forward or backward. Everything contributes. So if you want to contribute, chip in with what you would recommend for medical insurance, life insurance, in India, elsewhere, please feel free. Please use the opportunity. Let's keep this conversation going on a regular basis. We definitely need more refreshers from Vijay on investments. We need sessions from the likes of Sundar on options, futures, and all. Let's keep this as a regular dialogue.
Yeah, definitely.
Great. Very good.
That's what. Thanks, Murugan, and
Thank you very much.
Yeah, we just opened this, and and also we can break down by countries and have a follow-up discussion, so that's more relevant. But next session, I think, you can put a note saying that if you can convince Tamil to run the entire session, that's fine. If not, just 2 or 3 people can contribute, and we can have the next session. Yeah.
Good. Okay.
Thanks, guys.
Thank you so much, guys.
Thank you.
Super.
Bye, guys.
Fantastic.
Thank you, guys.